Hey investor friends, I'm Michelle Markey and today I'm going to discuss how I'm investing in 2024. I actually did one of these videos last year around this time as to how I was investing in 2023, where I talked about my investing outlook last year. And I think it's interesting to compare how we performed in prior years of investing to how we might change our investing plans for future years like now. So I think it'd be good to compare and contrast how I did compared to last year. And basically the nutshell is I probably didn't do that great because I mostly sat on the sidelines in high yield savings accounts, giving me 5% of interest, which while it was nice, it's not nearly as good as what the S&P 500 returned, including dividends, which was 26% for 2023. So I'm going to take some advice from a popular Wall Street Journal columnist named Jason Zweig and write a sort of future letter to myself in the form of this video as to how I'm trying to change some of my investing decisions, because I'm hoping for better than just mediocre investing outcomes, because I'm a little bit displeased with how I performed last year as an investor. So what I'm all about is trying to continuously self-improve, and I hope by sharing some of my feedback and learnings that maybe this can also help you put in perspective how you might think about your investing choices for the coming year. So now that it's 2024 and toward the end of January specifically, the Federal Reserve just ended their FOMC meeting as of January 31, and stocks kind of tumbled a little bit in reaction to how the Fed talked about not changing interest rates. So I'll talk about that, as well as where things seem to stand with inflation and how that may affect some of the stock market and the economy, because 2024 might be shaping up to be what they call a soft landing for the Federal Reserve. And before I tell you what that means more specifically, if you enjoy learning about investing and managing your personal finances, I hope you'll consider liking and subscribing to my video and YouTube channel, because I really hope that this will help you. And let's get into what I was about to say. So a soft landing is basically where the Federal Reserve would achieve their two mandates of having price and labor stability. So when we talk about price, that means that inflation is not too out of control, and also that there's full employment or as low unemployment as we can manage, which from some recent stats I've seen, unemployment was at around 3.7%, which was pretty close to historical lows. So it looks like we have a pretty strong labor market. And as far as inflation is concerned, that's hovering at about 2.9% as of December 2023. And that's based on the personal consumption expenditures inflation index, which is not the same as what's often quoted in the media of CPI inflation. So based on some of that, I think that it's looking like we're doing pretty okay as an economy, but the Federal Reserve is not yet pleased and declaring victory by any means. Based on what the Fed Chair Jerome Powell said today, he thinks that we're still moving toward their inflation target of 2% for PCE inflation, but we're not yet there. So if we're at about 2.9%, that's still 0.9% more that they want lowered until they might feel like we're sustainably at the inflation and price stability area that they're looking for. So without that part in place, it doesn't look like the Fed is willing to cut their federal funds rate anytime soon. And the Fed funds rate often dictates interest rates for everything else, like credit card, car, and mortgage debt. So whenever you want to get loans for something, that's often dictated by what the Fed sets their rate at. And often you'll see, mortgage rates will be adding to the Fed funds rate. So if the effective Fed funds rate is around 5.3 to 5.4% right now, because that's from their current range of 5.25 to 5.5%, you'll see that mortgage rates will have 3% or so added to that. So don't be surprised if current mortgage rates might be around 8% plus or minus. So that might be what a lot of average people might be looking at when they're trying to get a mortgage loan for buying a house. And maybe some people are even able to get lower rates than that, but so far it's not looking that much lower than, say, maybe 6% at the lowest for mortgage rates. So A lot of people are kind of looking forward to the Fed lowering interest rates maybe in 2024. But like I said, in order for the Fed to feel comfortable with doing that, they need to see that inflation based on PCE is heading toward and maybe sticking around 2% for them to not jump ahead of themselves and lower Fed funds rates preemptively. Because when they tried lowering Fed funds rate too soon in prior decades, that kind of backfired on some of the efforts to rein in inflation. So that's part of why the Fed is keeping rates unchanged and why the stock market reacted negatively on January 31st. So knowing that, it's something to keep in mind as to some people are penciling in 3 rate cuts this year. So perhaps JP Morgan strategists suggested maybe we could see rates come in June and September and December as far as some rate cuts, but perhaps as early as May, according to some other economists, that they think that would be the more likely time after the Fed meets in their FOMC meeting, maybe around the end of April, May. But as far as the next Fed's FOMC meeting in March, there's probably not going to be any changes again, because it's a little too soon to see if inflation will be lowered enough by that point. So if I had to take a wild guess, inflation might only come down sustainably closer to 2%, maybe by the summer, assuming that the summer doesn't heat up so much more with consumers taking a lot of vacations and spending more. Like, consumer spending was pretty strong in 2023, and that helped to keep the economy going, where we saw real GDP growth of about 3.1% if you average out all the GDP growth rates of 2023 quarters. So that seems kind of encouraging, because let's say you were in a high yield savings account like I kind of was, having some of my money in there. At least it was nice that the 5% I was getting was kind of staying ahead of inflation, where, you know, if inflation was say around 3%, I did better by 2%. So that part was kind of nice, that finally, unlike some of the prior years when inflation was eating the real purchasing power of your money, we as consumers, if we liked saving our money in high yield savings account, we finally clawed some of that loss back and we got a little bit more buying power. But overall, a lot of consumer sentiment is still kind of in the doldrums, because we are still facing a lot of elevated pricing and a lot of things cost so much more. Like if you want to make car or home repairs, everything is way more pricier than it had been. So it's still sort of dampening consumer sentiment. And even though people are happy to have jobs, there's a lot less people quitting as of recent figures, because maybe there's not that many more opportunities for higher paying jobs out there. So people are kind of just staying in place because maybe they're not sure what's in store for the economy this year. But nonetheless, instead of focusing so much on some of these macro ideas, something that I reflected on after the passing of one of my favorite investors, Charlie Munger, is that I would like to improve as an investor. And in a last Wall Street Journal interview he gave in November 2023, a little bit before he passed away, he said it's basically tough for us. Like, he said most investors should basically just park their money in an S&P 500 index fund. And maybe if you want to keep up, have some of your money in the Apples and Googles and maybe Microsoft, because the industries are basically boiling down to a few winners, and some of these big tech stocks are some of the few winners that we might see. And that's kind of aligned with how there's this term called Magnificent Seven of a lot of the popular mega cap big tech stocks. Like, you know, many of them like Apple, Microsoft, Google, Meta, Nvidia, and Amazon, and Tesla. And lately, even though Tesla is considered part of the Magnificent Seven, it's been kind of struggling of late because maybe consumer sentiment is not so hot on electric vehicles right now. So across the board, EV is not doing so great at the moment if you look at some of the stocks in that space. So even though there's that greater move toward electric vehicles because of environmental concerns, and at the same time, a lot of consumers are sort of just waiting. If they don't need to get an electric vehicle, a lot of them are waiting until maybe prices might be closer to the around $25,000 per vehicle average amount. And also for charging stations to be improved before they might be willing to make the switch from gas combustion engines over to EV. So with that in mind, it's sort of making sense that we're seeing Tesla getting hit. And interestingly enough, I remember when Tesla's market cap had reached over $1 trillion, and it's shrunk to a little bit under $600 billion when I last checked. And I kind of make the case, maybe as part of the Magnificent 7 or 8, we should consider adding Berkshire Hathaway, which is still led by another one of my favorite investors, Warren Buffett. And so if we think about that, I'd make the argument for a lot of us to consider Berkshire Hathaway and the rest of the Magnificent 7 as potential things we should consider in our portfolios, because I didn't really aggressively do that. Like last year, I bought some Berkshire Hathaway during some of the bank run crisis going on in March 2023, but I didn't get super aggressive about it. And now from that time, Berkshire Hathaway's up almost $100 per share as far as the Berkshire B share. So thinking about that a little bit, I'm kind of wishing I'd jumped in more into Berkshire Hathaway as well as maybe Apple in early 2023 before it catapulted to the around $185 per share range now. But as much as that's the case, it's not too late. So even though I kind of feel rueful about sort of staying out of the market some of the last couple of years, and I wasn't entirely out of the market, but I was out of it enough that I've been playing defense because the market is still kind of maybe overvalued based on some indicators like the Buffett indicator, which is the Wilshire 5000 over US GDP. And that seems to make the market still a little bit frothy, if not somewhat overvalued. And same thing with looking at the Shiller price to earnings cyclically adjusted ratio, which if you look at the Shiller PE, that's also still elevated. So there's not much that's a bargain. And that's part of why I've been so defensive last year, is like, it's so difficult to want to jump into the market, even though a lot of people are expecting rate cuts. So they think the stock market will go even higher when we get the Fed rate cuts. But with people like Warren Buffett and Berkshire Hathaway sitting on a cash pile of over $157 billion, and that's been juicing the earnings and returns of insurance companies like Berkshire Hathaway, that's been nice because they've been able to take advantage of 5 to 6% treasury bond returns. But is that going to be a kind of reliable strategy this year if the Fed funds rate lowers their rate from the current range, like I mentioned earlier, of 5.25 to 5.5% to potentially as low as 4.5 to 4.75%, depending on if the 3 penciled rate cuts actually do manifest this year. So that's definitely kind of a tall order that I think the market and economists are expecting from the Fed, given that they're still trying to wait for their PC inflation indicator to go down to around 2% in a sustainable way, remember. So it's not like everybody should be jumping for joy that the stock markets will suddenly go to the moon as soon as the Fed cuts its first Fed rate. I think that there's still more to be seen, because if you're kind of bearish and you're looking at what is Berkshire Hathaway doing, sitting on a bunch of cash that makes up maybe as much as 20% of their overall market cap, that's a lot of cash for any company to be sitting on. So when we see the moves of Warren Buffett and his investing lieutenants, what is that suggesting to us as everyday investors if we're trying to sort of follow in the footsteps of one of the best investors? So you could take it in a somewhat mixed approach, like maybe have some money in an index fund, like in your 401k, like I'm doing. That might be a way to go, just to, take advantage of, for better or worse, whatever happens to America's best 500 companies in the S&P 500 index, because that's what a lot of us might just be doing by default. And then in addition, maybe as far as my portfolio is concerned, I'll be looking to see which among the top stocks in the S&P 500, especially looking at the Magnificent 7, do I want to put in my portfolio. And another thing I'm considering doing is doing a little bit more at a time. So historically, I'd prefer to just gather a bunch of cash and then pile it into something. And I sort of regret cashing out of Google because I thought I paid too much, and now it's way up higher than even what I paid. And then I sold out because I was a little afraid of how AI might take away advertising revenue market share from Google, but they seem to have since recovered from that initial ChatGPT AI fear. So with some of that kind of in the background, it looks like the market has reinvigorated a lot of tech stocks. And even though the NASDAQ pulled back more from today's Fed decision to keep rates unchanged, there's still a lot of faith that the market is putting into the big tech and Magnificent Seven stocks, Tesla notwithstanding. But with some of that in mind, it kind of, even though you could feel like you should wait on the sidelines and see what might happen this year, I've been encouraged by another investor that I admire to not just sit on the sidelines. So money market was kind of nice when a lot of people were expecting a recession last year, and maybe a recession could still be in the cards in 2024. Who knows? Like, nobody can predict the future, but I'm not going to wait for a recession before I start more aggressively investing is kind of where I'm heading as far as my thought process. So based on what I read from this columnist Jason Zweig, which has been the editor of The Intelligent Investor, written by Benjamin Graham, who was Warren Buffett's mentor, and Warren Buffett respects a lot what Benjamin Graham taught us. From Jason Zweig's article he wrote a few days ago on around January 27, 28 in the Wall Street Journal, he said that we as investors can time travel too. And he recommended that, much like how Rip Van Winkle woke up 20 years later in the Washington Irving story, and Jason Zweig was on a book sabbatical, so he didn't really pay attention to the market after May 26 last year. And he's come to find that a lot of economists' predictions weren't really that correct. And what we can do is, as his advice, is to write a letter to ourselves. And for me, I'm doing a video to myself in the future to talk about what decisions I'm planning to make this year and compare and contrast next year how I perform. So some of that, I'm just going to refer to some of my notes to kind of recap some of what we could also do if you want to be in a position to make more deliberate decisions that hopefully will help you be in a better mental framework in the future. So with some of that, I'm going to look at what I'm thinking about, which Jason Zweig said to write in our letter to our future self. Let's detail what we're planning to do and why we think our investment decisions make sense and what results we might foresee. So based on thinking about some of that, what I'm guessing is the stock market might do all right. Like, if it performed at 26% last year, even though that's really ambitious, and the stock market had been performing, I think, north of 15% per year on average for the last 6 years, even though they've done really well, that's way above the stock market's historical performance level. So it's a little bit rich to expect the stock market will perform as well as it did in 2023, but we could be in for a surprise. It could either do just as well as last year or decline, or maybe perform in the stock market's overall 200-year average rate, which was around 7%. So maybe you can expect the average market to perform between 7 to 10%, and that would be pretty good. Like, that's a year's worth of returns you could on average hope for, which is good enough. Like, I think that if any of us are lucky to get 10 to 15% returns on our portfolios, that's pretty good. And that's what I'm shooting for. Is ideally, I'd prefer to get around 15% returns on my portfolio if I can make better investment decisions. So with some of that, also, he kind of put in mind what we might think about, like, will our investments in any given stock kind of sabotage our happiness? So none of us should be losing sleep or getting anxious about what we're putting our hard-earned money in. That would just be unfortunate if you kind of just keep regretting your decisions and keep thinking the grass is greener on another side. Like, I think we will be better off if we don't dwell so much on stuff like that. And also, let's consider that if you're worried about some factors like retirement or tax planning, what outcomes do you want to see for that? Because let's say one of your goals is to minimize your taxes, then maybe you don't jump in and out of the market and have a lot of capital gains or losses to have to deal with, or think about some of that as far as what's important to you with taxes, or are you worried about running out of money for retirement? That could be on a lot of people's minds. If I was close to retirement age, I'd be worried about, do I have enough money to afford any unexpected healthcare expenses? Like if, heaven forbid, something happens to people and they get hospitalized, can you afford that? Do you have enough coverage to make sure you're able to cover any unexpected medical situations? So that's something I think about, as well as, another thing he's encouraging us to think about is how our life would be different, or our portfolios, if we didn't react or overreact to news we saw. So it looks like the stock market is reacting right now to the Fed's decision to keep rates where they are, which could be good or bad depending on your point of view. Like, it's good for people who like to save, like me. I like to save my money and milk some of that interest from high yield savings bank accounts. But maybe if I wanted to get a mortgage, that's a little uncomfortable because now I have to pay more to a mortgage lender in order to buy a house. So there could be pros and cons, but as long as you try not to overreact to the news and try to have a plan that you set out for yourself and high level goals that you're looking to achieve, and try to stick to that. Like, if you stay true to yourself and your plan and you did the best you could, no matter what happens in the market, that's all you can hope for. So I wouldn't beat yourself up no matter what. So as much as I wish I could have been a better investor in 2023, I'm keeping a positive attitude and looking toward the future. So with that, if you found this video helpful, I hope you'll like and subscribe, and let me know in the comments what you think. I'd love to hear from you what you're planning to do in 2024. Like, are you going to consider investing in what one of my friends has talked about as investing in Mango, which is a lot of the popular stocks like Microsoft, Apple, Nvidia, and G for oil and gas, and T for Tesla, and A for Amazon, let's say. Like, there could be so many of these potential stocks that you might be considering in your portfolio, and the sky's the limit. Like, you can do well for yourself if you do your homework and research companies that you believe in, like what I've talked about. I'm a big believer in fundamental analysis and looking into companies' 10Ks, like what they put on their investor relations page, and reading the CEO's letter so you can get a feel for, do you believe in what this CEO has set out for the company, and are they actually delivering on their promises that they made or the goals that they set out? So you be the judge of which stocks you're wanting to invest in, or if you just want to put your faith in the American economy and an S&P 500 index fund, whatever you think is right for your investing temperament and ultimately your portfolio. So I hope this helps, and till next time.